Imagine waking up to find your home's value jump almost 9%. In Florida, one policy on the table could do exactly that, while widening the gap between those who own and those who don't. Here's the setup. Two powerful currents are colliding in the Sunshine State. On one side, a push to eliminate property taxes entirely, with economists estimating a 7 to 9% bump to home values the moment the policy takes effect. On the other, Florida now leads the nation in foreclosure distress, with 1 in every 1,829 homes facing foreclosure in October 2020 to 5. Tampa sits at the epicenter, with 1 in every 1,373 housing units in foreclosure that same month. The knife edge between windfall and risk is razor thin, and the next year will determine who benefits and who gets squeezed. Start with the property tax gambit. Analysts running the numbers say removing property taxes statewide would raise the aggregate value of owner-occupied homes in Florida by roughly $200 billion to $250 billion. The logic is simple finance. Lower user costs today, higher valuations now. In other words, a 7 to 9% jump on paper the day the tax disappears. But big windfalls rarely land evenly. Experts also flag that the benefits cluster with existing homeowners and those with more wealth, while first-time buyers already stretched face higher entry prices. The rules won't bend themselves. Eliminating property taxes requires a constitutional amendment in Florida, meaning 60% voter approval. Lawmakers have sketched 8 possible ways to reduce the property tax burden, with 7 proposals slated for the 26th general election ballot. One of those would eliminate the tax on non-school homesteads. The scale of the change is enormous, the timing precise, and the stakes very real. While policy debates simmer, market reality is not waiting. In October 2023, 5 nationwide foreclosure filings totaled 36,766. That was up 3% from September and 19% year over year. Florida stood out with the highest state foreclosure rate, 1 in every 1,829 homes. Tampa ranked first among large metros, with 1 in every 1,373 housing units facing foreclosure. Local dynamics help explain why Tampa jumped to the top. The resumption of data collection in Hillsborough County and the addition of backlogged filings both hit the tape at once. Even with that nuance, the message is hard to miss. Pressure is building, costs are piling on. Ask agents on the front lines around Tampa Bay, and a pattern emerges. Families who bought during the explosive 2020-23 run-up are learning that selling isn't the easy off-ramp they imagined. In some cases, the math says they'd need to bring roughly $10,000 to the closing table just to avoid a short sale. That's not a number pulled from a spreadsheet alone. It's the figure that shows up when the net sheet turns negative after HOA fees, interest, insurance, and all the friction that comes with moving. For a retiree or anyone on a fixed income, a few percentage points on any of those lines can become the spark that lights the fuse. Costs tied to housing have climbed across the board. That's not a vibe, it's the budget. Associations raise monthly HOA dues. Mortgage payments reset at higher interest rates. Insurance premiums rise. When 3 lines on a household's ledger all angle up at the same time, and income doesn't, foreclosure risk follows. Economists warn that those increases pinch certain groups more than others. For people living on fixed incomes, housing often eats a huge share of their spending, so even small changes can hit like a big one. And this strain is happening while the broader conversation entertains a policy that could push prices up another 7 to 9% if property taxes go away. Where prices sit now depends on the street you're standing on. In Southeast Florida, from Vero Beach down to Boca Raton, median prices are ranging from $365,000 to $485,000. That corridor runs on its own seasonal clock. Seasonal renters arrive on January 1. Buyers who fall in love in February start writing offers by March. This is a small window, 3 months on the calendar, a few weekends of touring, and, often, the move from north to south captured in a single wire. But the Florida market doesn't move in a straight line. It shifts by price tier and by the patience of sellers. National data show the upper end, roughly the $750,000 to $1,000 range, has logged some of the largest sales gains. The lower end remains tight on inventory and even tighter on affordability. Sellers who overshoot on price learn what the market's time penalties look like. An average reduction of 4.9% when a listing sits 0 to 14 days, a 6.1% cut after 15 to 30 days, a 7.3% cut at 31 to 60 days, then 9% at 61 to 90, 10.6% at 91 to 120, and 13.8% once a listing crosses 120 days. Time on market is not neutral. It erodes list prices, step by step, as the weeks stack up. This uneven map also shows up in who's buying. First-time homebuyers nationally fell to 21%, far below their historical norm, around 40%. The median age for a first-time buyer is now 40. Those numbers reflect the same tension the state tax debate brings into focus. Homeownership is getting older, wealthier, and more selective. Meanwhile, repeat buyers, particularly those who can pay cash or tap equity built in earlier cycles, are closing more easily. Florida is not isolated from those national realities, it's a vivid example of them. There is one more axis to track: timing. National economists anticipate the housing market's real rebound hitting in 2026. A 14% jump in home sales is forecast for that year, following mostly stagnant levels in 2025. New home sales are projected to rise 5%. Price growth is expected to continue even as sales accelerate, 3% in 25, then a median 4% in 2026. Mortgage rates are forecast to average around 6% in 26, down from roughly 6.7% in 2025. Even modest rate declines can unlock demand, which is already showing up in higher frequency indicators. In one recent reading, mortgage applications for home purchases ran 31% above the prior year's week. Beneath the numbers sits a broader context. Job growth has held, builders keep adding supply, and a 43-day government shutdown, an episode that could have delayed some closings, eventually ended. None of these threads alone delivers a boom. Together, they set the stage. Now weave Florida's tax experiment into this backdrop. If voters approve a plan that eliminates property taxes outright, economists estimate an immediate 7 to 9% jump in home values. That shock would appear first in listing prices and appraisals, and second in closings. A move of that size would add roughly $200 billion, $250 billion, $250 billion to the value of owner-occupied homes in the state. For anyone with ample equity or cash, the math makes sense. For first-time buyers, the latter just lost another rung. This is why the debate includes not only how much to cut, but who pays for it. Without property taxes, local governments must fund services some other way. Analysts caution that full elimination would likely push the burden to other sources, like higher sales tax percentages, increased local fees, or service cuts. The policy lever doesn't erase the cost, it shifts it. Skeptics also call out the business cycle risk embedded in the plan. As long as the economy stays out of recession, a higher price environment with strong demand can hold. But Florida carries a distinctive exposure: vacation homes. Roughly 10% of the state's housing stock are second homes. In a national recession, owners of vacation properties often sell first. That wave can create a glut. The scenario isn't just lower prices, it's lower tourism dollars, fewer bookings for short-term rentals, and a squeeze on tax revenues at the exact moment a budget might be most fragile. The black swan risk is calendar-based. A recession hits while tax receipts fall and inventory rises. One market forces another. Meanwhile, distress is already here for some. In October 2022-5, Florida posted 4,136 foreclosure starts. Tampa spiked to 1 in every 1,373 units in foreclosure, put a spotlight on Hillsborough County's backlog clearing and the resumption of filings. And yet, even inside that storm, there's a message that avoids exaggeration. The rise in foreclosures nationally has been characterized as a return toward typical volumes rather than a collapse. The numbers, 36,766 filings in October, a 3% monthly increase, and 19% year-over-year don't erase pain. But they do suggest a normalization as households navigate higher housing and borrowing costs. At the same time, some metros outside Florida are moving in the opposite direction, with year-over-year declines in foreclosure starts posted in places like Milwaukee, Indianapolis, Louisville, Washington, D.C., and Detroit. The map matters. Florida is a hotspot today. It won't necessarily be tomorrow. On the ground, the microeconomics turn personal fast. Imagine a homeowner in St. Petersburg who bought in late 2022 at a peak price. Their agent updates comps and finds the property would sell for roughly the same price today. The net sheet subtracts commissions, taxes, HOA prorations, and lender fees. The line turns red. To close without a short sale, they'd need to bring about $10,000 to the table. They look at insurance renewals higher, HOA dues higher, interest on a variable rate loan higher. The math says they can't sell and they can't afford to stay. The foreclosure process has already begun. The advice from those who deal with this every day is blunt. Talk early before the bank starts. Waiting doesn't improve the numbers, it shrinks the options. Contrast that with a cash buyer in Boca Raton aiming at the $750,000 to $1,000 range. Inventory has been more robust at the upper end. Price growth has been steadier. Seasonal buyers land on January 1, test drive a neighborhood for a month, and write an offer by March when they find the right block. In that corridor, median prices running from $365,000 in Vero Beach up to $485,000 in Boca Raton set the baseline for the broader market. Demand isn't a whisper, it's a season. Market mechanics don't pause for policy. Sellers who want to move homes in a slow winter learn the price reduction playbook by heart. 0 to 14 days on market, a 4.9% cut might shake loose a buyer. 15 to 30 days, 6.1%. 31 to 60 days, 7.3%. 61 to 90, 9%. 90 to 120, 10.6%. Over 120, 13.8%. Price appropriately and you move. Aim too high and the steps down get steeper each week. Zoom back to the statewide calendar. In October, legislators assembled 8 options to reduce property tax burdens. 7 are set to appear on the 2026 general election ballot. One proposal targets homesteads that aren't tied to school funding, eliminating tax on those non-school homesteads. The big swing total elimination of property taxes needs a constitutional amendment, and 60% of the vote. This isn't a minor ordinance, it's the rulebook of property and budgets. If voters back a plan that stretches beyond tax relief and into tax removal, the price chart shifts within days. Between now and that ballot, Florida will keep living in the market it has. That means monitoring foreclosure flow, 4,136 starts in October 25, is a number, not a destiny, and watching places like Hillsborough County work down backlogs. Analysts expect Tampa's rate to stabilize as the administrative surge passes. It also means keeping an eye on national currents. If the forecast holds, 22.6 brings a 14% climb in home sales, 5% growth in new home sales, and a price track that adds about 4% on top of 22.5's 3%. Mortgage rates drifting toward a 6% average in 26 down from roughly 6.7% the year before won't make affordability easy, but they can open doors that stayed shut at higher rates. For those working inside the industry, a reminder that Florida's data lens is getting sharper. In Fort Myers, a regional summit built around the theme Data Over Drama brings residential, land, and commercial experts to a single stage. It's a tight program, 4 p.m. to 7:30 p.m. at the Colusa Sound Convention Center, with sponsors stepping in at tiers of $12,000 for platinum, $8,500 for gold, and $5,000 for silver. That may sound like the inside baseball of events, but it signals something larger. Real dollars chasing real clarity in a market where 7 to 9% swings can arrive with the stroke of a pen. None of this erases Florida's structural divides. First-time buyers are down to 21% of the market nationally, far beneath their 40% norm. The median age for a first-timer is 40. That's a financial biography as much as a statistic. Longer renting, later household formation, a harder climb to a down payment. Improve the cost of debt by cutting rates to 6% in 26 and you help at the margin. Strip property taxes out and you widen the gap in the other direction by pushing values up 7 to 9%. The distribution of impacts matters. The upper end $750,000, $1,000 sweet spot moves briskly. Entry-level fights for every deal. The contradiction is the story. Florida leads in foreclosure rates. 1 in every 1,829 homes in October 2025, and yet statewide values could jump dramatically if property taxes vanish. 1 in every 1,373 came with an explanation tied to data collection resuming and backlogs clearing in Hillsborough County, but the pain behind the number is still real. National filings, 766 in that month, point to an environment adjusting to higher costs. And still, there's a path where 2026 brings a 14% surge in sales with prices up 4%. These forces don't cancel each other. They compete, and the result is a market with both high drama and high data. Let's run the calculators on scenarios. If voters approve a full property tax elimination in November 2026, a 7 to 9% home value jump becomes the new baseline on a $365,000 median home in Vero Beach. That's roughly $25,550 to $32,850 in added value. On a $485,000 median in Boca Raton, you're talking about roughly $33,950 to $43,650. Aggregate, that's the $200 billion to $250 billion lift statewide for owner-occupied housing stock. Now overlay the forecast. If prices are set to rise 3% in 25 and 4% in 26 absent tax changes, that 7 to 9% policy shock compounds the trajectory. Good for owners planning to sell or borrow against equity. Harder for first-time buyers aiming at a down payment that just grew by 5 figures in a day. The fiscal side is less cinematic but more consequential. Removing property taxes means someone else writes the check. Analysts argue the state cannot afford a full elimination without increasing sales taxes by some number of percentage points, raising local fees, or cutting services. The phrase to remember is cost shift. The burden doesn't disappear. It moves. For a household investing in a first home, a policy that inflates prices by 7 to 9% while raising ongoing costs through other taxes or fees lands twice. For a homeowner with a paid-off property, it lands as a gain. There's also the cycle risk, the black swan. Around 10% of Florida's housing stock are vacation homes. In a recession, second homes often flood the market first. If that wave arrives at the same moment the state relies more on tourism dollars and sales taxes, revenue shrinks while listings jump.
Bin, inventory rises when buyers pull back.
Prices soften, the budget tightens. It's not the base case, but it's not a ghost story either. It's the combination to watch. Even under strain, not every indicator is flashing red. Mortgage applications jumped 31% above the prior year's week at one recent reading. That's a sign of pent-up demand waiting for rates around 6% to feel livable again. Builders are still putting up homes. Jobs are still adding stability. A 43-day government shutdown delayed some deals, then ended. And while some metros are cooling on foreclosures, Milwaukee, Indianapolis, Louisville, Washington, D.C., Detroit, Florida's spike carries explanations that are partly procedural. Once Hillsborough County clears the backlog that helped push Tampa to 1 in every 1,373 units in foreclosure, analysts expect a more stable baseline for the region's numbers. If you're a seller in this environment, the playbook is blunt. Price to where the buyers are, or watch reductions stack from 4.9% in the first 2 weeks to 13.8% after 4 months. If you're a buyer, remember the market is still a patchwork. In Southeast Florida, median prices run $365,000 to $485,000 from Vero Beach to Boca Raton, and seasonal rhythms mean January 1 to March is the heart of the action. In Tampa, be sober about comps and timelines, because 1 in every 1,373 units in foreclosure in October 2025 means more distressed sellers in the mix, which can shape neighborhoods block by block. If you're a policymaker or voter, internalize that a constitutional change requires 60% support and could shift values by 7 to 9% overnight while moving the cost of public services to other lines on the ledger. So where does this leave Florida? Base case. 2026 looks brighter. Nationally, home sales rise 14%. New home sales tick up 5%. Prices add 4% after 3% growth in 2025, and mortgage rates average around 6% instead of roughly 6.7%. In Florida, that backdrop should help cool the foreclosure rate as more refinancing windows open and as Hillsborough County's backlog clears. Seasonal demand from January to March keeps Southeast corridors active, with medians around $365,000 to $485,000 anchoring transactions. Absent a dramatic tax overhaul, the market follows the macro uneven but upward. Two watch items could bend that path. First, the property tax ballot cluster through November 2026. 7 proposals are set for voters, and any move toward eliminating taxes on non-school homesteads or going further toward full elimination could push values 7 to 9% higher, changing affordability overnight and shifting local revenue burdens. Track the debate, the exact language, and whether a full constitutional amendment clears the 60% threshold. Second, the foreclosure pipeline in Florida through mid-2026. October 2025's numbers: 1 in every 1,829 homes statewide, 1 in every 1,373 in Tampa, with 4,136 foreclosure starts, came with a procedural spike. Watch the trend once Hillsborough County clears the backlog. Does the rate settle, or does ongoing pressure from HOA dues, insurance, and interest keep the line elevated? Between these markers, Florida walks a tightrope. The state can unlock a $200 billion to $250 billion lift in owner-occupied value with a single tax policy. It can also tilt affordability further away from first-time buyers, already down to 21% of the market, with a median age of 40 in favor of those with equity or cash. The upper tier keeps moving, with $750,000 to $1,000 deals seeing some of the largest gains. At street level, sellers who miss the mark lose ground every 2 weeks: 4.9%, then 6.1%, 7.3%, 9%, 10.6%, 13.8%. Buyers gauge risk against the prospect of 6% mortgage rates in 26. Investors do the same, but with a calculator that includes the possibility of a recession and a 10% slice of the housing stock that's second homes. Florida has always traded on sunshine and risk. Today, the numbers bring both into sharp focus. 1 in every 1,829 homes in foreclosure statewide in October 2025, 1 in every 1,373 in Tampa. 32,672 and 66 filings nationally that month, up 3% from September and 19% year over year. A 7 to 9% potential leap in values if property taxes vanish. A $200 billion to $250 billion aggregate lift. 8 legislative pathways drafted, 7 set for the 2026 ballot, and a constitutional threshold of 60% needed to go all the way. A forecast for 22.6 with 14% more sales, 5% more new home closings, a 6% average mortgage rate, and 4% price growth after 3% the year before. A 43-day shutdown that ended. A 31% surge in mortgage applications in one recent week, a market that punishes every extra day on market with cuts from 4.9% to 13.8%. And along the Atlantic, median prices from $365,000 to $485,000, enticing seasonal renters who become buyers by March. The data is loud. The path is narrow. Florida's housing story over the next 20 months will be written by ballot language measured in percentages, foreclosure ratios measured in thousands, and rate moves measured in fractions. If the state decides to erase property taxes, that choice will echo as a 7 to 9% price shock, visible on every listing sheet from Vero Beach to Boca Raton. If recession arrives while second homes, about 10% of the state's stock, hit the market, the shock will run in the other direction. If neither happens and the national forecast lands, 22.6 becomes the comeback year the market has been waiting for. However it plays, the lesson holds. Watch the numbers, not the noise. Track 1 in every 1,829, 1 in every 1,373, 4,136 starts. track 7 to 9%. Track 200 billion to 250 billion. Track 14% and 6%. Track 60%. And for those making moves, remember the gravity of time on market. 4.9%, 6.1%, 7.3%, 9%, 10.6%. These aren't abstract. They're the rules of the road. If you want more data-grounded Florida housing analysis with clear numbers and no noise, stay with us.